Good evening, Bloke here, and this is going to be covering a share that is going to report in just over a week's time. So, I actually recorded this article back in November, and this was based upon this half-year trading update. So, the company itself reports from April till October is the first half year, and then it's November through till end of March. No, hang on, haven't got that right. November through to the end of April. Apologies. So it's May till October and November till April. So in that update, which I wrote this article upon, there was quite a few things that I think gave gave you some positive feelings about the outcome of the future outcome of the works. None of this is advice, and it's just my opinion. But when you look at the works share price, it's now sat at £20 million market cap, so it's at about 34 pence a share, and has come down quite a bit. Now, it's my contention and belief that the result in just over a week's time, so it'll be a week Thursday, is actually going to be, I think, laying the groundwork for a stronger update. Because the other thing that they'll do in the half year results is also give a Christmas update, and Christmas, of course, is a key time of year for the works. So, okay, so there's other people that cover this idea as well. So one of those, Mr. Rebel, has spoken. In fact, I think it was down to sort of him and one of the fun runners from last year's imaginary fun run race of top share ideas was what made me look at the works in the first place, really. Um, and I mean, when I looked at it, I kind of looked and saw that the online looked actually a lot better than it was being portrayed. But on the basis that Mr. Rebel has spoken to the CEO of the works, who says that online kind of isn't necessarily making any money, um, then obviously that puts a bit of a dampener on things. Now, to work out that from what I saw that it appeared to be making money was I was taking the online variable costs, so that's costs that um, relate to the website, to the online sales, taking an average of gross profit margin to work out whether online sales were or were not profitable. Obviously, that's an average. So if the CEO is saying it's not, then what must be happening is that the cost of sale is not uniform across online and bricks and mortar, but it's more expensive through online. Because of course, when you're selling through a shop, you've got heating, you've got security, you've got staff costs, you've got all manner of costs that you wouldn't have online. But with online, obviously, you've got the cost of the website, you've got the cost of postage and packing, fulfillment, all of that good stuff. So it's horses and courses, but we seem to be told that it's not making money. As I say, I mean, when I looked at it from an average profitability point of view, it seemed to me that it was making money. That the e-commerce profit appeared to be anything up to 1 million a year, which would therefore mean if you got rid of it, you're going to lose 1 million of profits, which doesn't make any sense at all. And that was based upon average gross margin being that, based upon that level of sales, the online variable costs being that, and that minus that gives you the profit. So in the first half results, I mean, we don't have the exact numbers yet, but what we're told is that I'll show it to you here. We're told that the sales have dropped 36%. So it's this bit by here. Sales declined by 36% in the period, and they're working on a long-term solution. So obviously that's a negative. Now what I've done is take those same numbers, so taken the online variable costs, and and use those. So I've taken that, but deducted out the exceptional costs from the prior years to arrive at 6 million. So it's basically taking the results from that period, deducting out the 1.2 to get my 6 million of online variable costs, and then taking the same profit. Again, average profit margin looks to me, I mean, that will get you to 4.5 million gross profit based upon the sales, taking the margin into consideration. And then with that 6 million online variable costs, it looks like it's potentially losing 1.5 million. So that's obviously a very negative result and not great. But but we know overall sales, because you see them up here, 123.8, which, on the face of it, you could look at that and go, oh, well, the sales are down 0.3%. Well, that's a bad result. But actually, that result I was actually quite pleased with, because I started doing the maths on it. That's the number there, 123.8. Worked out the online was that, worked out that they had some new stores, and I made an assumption that they were mid-period, so they had sort of 3 months worth of revenue, and I took the average revenue to sort of work out again a kind of a guesstimate of how much revenue they produced. But what that sort of told me, and because we knew that like for like was 0.3% up, and I took the last year numbers and increased them by 0.3%, I then get this, what I call missing revenue of 8.4 million. What's missing revenue? So I'll tell you, the missing revenue is essentially like moves. It's stores that have been refurbished, stores that have been closed down, stores that have been sort of altered. So it's all of those. I think for me, the thing that really stood out was, despite the introduction of increases of employers NI and also minimum wage, that we're only seeing that we are actually seeing a 3% increase to gross profit margin. So an increase from 59.3 to 62.3. And again, I worked that out by, we were told that it's a plus 300 bips. The result in 1H25 was that. So therefore, the result in 1H26 is 62.3. Okay, anyway, that's kind of where I got to with all of that. So I guess one thought was to kill off the online, and my own thinking on that is, well, no, because that's part of the strategy to increase and grow sales to 375. You can see it by here. Online and multi-channel customer experience is a cornerstone of their strategy. So would you close down the online? Well, I suppose if you change your strategy, you would, but equally, when you're getting 31 million visits online, are you going to get 31 million people visiting your shop instead? I don't think so. I really do not think so. So you would lose sales, and obviously some of those 30, I mean, not all of those 31 million visits have resulted in a sale. I'm on their website today and I'm not buying anything. But yeah, some of those will be people browsing, some of that will be people just curious, some of that will be all sorts of things. But obviously in here, if I want to place an order, free collection over £30, free click and collect over £20. So it's looks like they've changed this since I've last looked at it, where they've now sorted out the fulfillment to quite an extent. They are saying 5 working days. Works got themselves, I think, into trouble based upon the reviews I've read, where they were perhaps suggesting that they could do next day delivery, and then people weren't getting their stuff the next day, and then, as people do, complaining about the fact they didn't get their goods or whatever the next day. It's so yeah, that's kind of what we're seeing, on their website. So I guess the thing that stood out was the missing revenue. So that tells me that 6% of the sales were not like for like, and if they're not like for like, then that means that they're either opening, closing, relocating, or refitting. Okay, and that for me was again like a real positive, because that's a doubling, 4% like for like, is a nearly doubling from the 2.3 like for like, and because that includes online. When you actually strip out the online, then it's a lot. It's actually a lot higher, which for me was the real positive. Wasn't there in the actual update, but when you strip out the 36% negative, you actually end up with a much stronger performance when you actually look at how the shops themselves are doing, which I thought was great. Now, I basically did some analysis on where I could sort of foresee the price going, and this 9.5 net profit would get you to well, based upon a 22 million market cap. Today it's 20 million, so it would actually be maybe 2.1. The lower end of expectations was more like a 5 million net profit, which would be a 4.0 price earnings, based upon today's 20 million market cap. I mean, they're indicating an EBITDA of 11 million. So to get from 11 million to 5 million net profit, I mean, you can sort of see me do it here. That net profit uh, it would be something like this, where, so if we go up and have a look at our EBITDA profit, like say this one here, 11 million as well. I mean, that translates down into a 6 million net profit. So you can sort of see how, when you take out finance expense, when you take out tax, when you take out those adjustments, and there's also some potential for some other adjustments as well, that you can kind of get to something like a 5 million net profit, which I think puts it very, very cheaply. But what I came up with was these numbers here. So as you can see, a net profit estimate of 9.4 million, which of course is a lot higher than 5 million, substantially more. So why do I believe 9.4 million when that's quite a lot higher than consensus? So I mean, I sort of say here, it may exceed, and I don't know this for sure, it's my supposition, but I contend that it could exceed expectations and actually deliver a far stronger result. Now, it is also true to say that the first half results, you can sort of see, I'm actually assuming that the first half result could be -2 million, where the second half result is positive 12 million. And the reason for that is, well, you can see here, I mean, it was the same last year, that this actually delivered a -6.2 million in the first half, and then a positive 14.3 in the second half. So overall, delivered an 8.1 million net profit. So that's because of the timing of the seasons, May to the end of October is not Christmas time, and the other 6 months is Christmas time, and Black Friday, Christmas, New Year sales, etc. So and Easter, I guess you've got sort of all your big celebrations, all your big events in the second half of the year, which is then why there's a stronger result. So that so I suppose the key contention here is, if we see in a week's time a loss in the first half of much less than the prior year, which was -6.2 million, my own estimate, based upon 100, we know that this revenue number is this, we know that the cost of sales is this, and the gross profit is this, because we've, well, or at least we know that the gross margin is 62.3%. Now I'm included in that cost of sale the cost of shops and the cost of leases and so on to arrive at that gross profit figure there. But that's coming out of, let's just get my spreadsheet. That's coming out of a calculation where I'm taking that from yeah, so I'm taking that from the sales figure minus 0.377, which would be the 62.3. 1 minus 62.3 is 37.7, and then I'm taking I'm taking I'm reducing that by, just see, 56.9 to give myself, and I'm using that 56.9, which is the gross. Where am I getting that from? Good question. Good question. Anyway, there was a logic to it. I just have to think what that logic is. But anyway, and I think I mean, it's consistent, as you can see, with pro rata to say last year, where it's 152 and 114. So yeah, what this kind of shows you here is that it's sort of roughly in line with the prior year cost of sale, which actually, because the margin has increased, that kind of doesn't really make sense that the margin would be roughly the same in fact. But anyway, on the basis that that's more or less correct, because we already know these numbers. Sorry, this number here is correct because we already know these numbers. Distribution costs, well, I'm sort of putting that down to be the same as the prior year. Same on the admin costs, so they've not sort of achieved any cost savings, and that gets us to an operating profit of minus 0.5, and then minus the finance expenses, plus adding back the tax gain on losses, gets you to the minus 2 million. To me, that looks quite a reason. I mean, I'd be surprised if it's vastly different from that. Maybe it will be. Maybe there'll be exceptional costs. Maybe there'll be. I mean, there are sort of things like gains and losses through hedges on currency and things like this that are very hard to predict. I mean, you'll sort of see that they sort of sit below the line and they sort of happen. They sort of happen regardless. So anyway, I could see this being a fairly I'd like to think a fairly likely result. And I mean, if we're going to be seeing a net profit of 10 million or something close to 10 million, and you can buy this company for 20 million, well, it's on a price earnings of 2 times, if I'm correct. And all you can see I'm doing here is I'm more or less saying, well, the revenue's pretty much online with the revenue from the year before. Costs are pretty much online for the year before. Now, on one hand, they have had cost increases through employers' NI and so on, but then they have also achieved cost savings, and they tell us as well that they've achieved a 3% increase on gross profit margin as well. So as long as the volume holds up, and as long as the increase of costs is offset by an increase in revenue or increase in margin, I can see this sort of being a fairly likely outcome. As I say, I mean, there are some things like exceptional costs and hedge costs that are very, it's like I wouldn't even want to take a stab at what those might be or could be. So it might be greater or less or different because of that. But if you've got an underlying performance where you've got something where it's about 2 times earnings, I just think that's really cheap. And I know the share price has gone up over the past. Well, I mean, I think you could have bought it 18 months ago, something like that, for a fraction of what it's for sale for today. But in fact, let's just pop him over there. So if we look at a chart going back, let's go back 3 years, something like that. So yeah, you could have bought the works for 18p back here and 19p, and you can see it was sort of at sort of 20-ish or 27p down to, yeah. So last April it sort of fell to 18p, shot up to 65p, and has halved since then back to 33p. So yes, it's more expensive than it was 20 months ago, but it's also half the price that it was 6 months ago. And at the end of the day, I think there's so much gloom and doom about retail and retailers and the UK economy generally. Um, it doesn't seem like it's going to take very much for this to actually, it's only got to do as well as it did last year. And 2020, Christmas of 2024 was not any kind of spectacular year for it to actually bring home the bacon. Um, and because they've achieved that margin increase, particularly, this for me was the real, when they sort of showed that, I thought, well, fantastic. Because and again, like, is there any reason to imagine that that shouldn't feed through into the second half? Now, yes, it could be that the admin costs have increased, but they do say about notable progress on the £2 million cost reduction program, people costs, efficiencies, the new mezzanine level that drives efficiencies. So yes, you've got an increase because of employers NI, but then you've also got a decrease because of efficiency. So which way will that come out? Will it be neutral? Will it be negative? I think there's a lot of negativity built in and assumed when it kind of might be quite marginal. Um, and even if my forecast's quite off, off by several millions. I mean, let's say I'm off by, 40%. I mean, you're still talking a 6 million outcome, and a 6 million outcome on a 20 million market cap. I mean, you're still talking a price earnings of just over 3 times, which is still cheap. Like, I don't know, whichever way you dress it up, it feels to me like there's a very a decent margin of safety to this. Um, and there's sort of some commentary where people have said, oh, but it's earnings. I mean, this was a comment made by another commentator where they said, oh, the earnings per share have collapsed. I was like, collapsed? Really? Anyway, I went back through all the numbers. This 12 pence earnings per share, nobody ever forecast that. I don't know where this has come from, but I've gone through all of the past broker notes. Did anyone guess? Did anyone give a broker guess of 12 pence per share that the works would be generating 12 pence per share earnings? No, nobody ever assumed that. Everyone was sort of saying 5p, 6p. And to be fair, this bit here is accurate, that they sort of said, oh yes, it's going to be earnings of 5p, then changed their mind and said it's 6.7, and then dropped it down to 6.1, which is that slight fall that you see there. And the fall, I mean, we could talk about the fall. The fall was down to cash expenses of leases are assumed static, suggesting a much reduced real operating cash flow, which yeah, so there was sort of quite specific reasons for the reduction in earnings per share, which may or may not come to pass. In fact, when you actually look at the numbers being referred to, it didn't really make much sense to me. Yeah, I think it was it was here. This apparent halving of the forecast, yeah, is just not not accurate. And there's no other way to say it. And even this reduction of zero point 0.6 of a p, that didn't add up either, because let's see if I can find. Um, can't remember where I put it, but yeah, I did sort of look at that and say, well, the adjustments that you're making kind of don't add up to zero point 0.6 of a p earnings per share reduction. Anyway, doesn't matter. The So yeah, when I looked at it from a cash generating point of view, I suppose the other thing that struck me was that whilst we see quite a movement to now, they did tell us that net cash was minus 5.3. Again, that's here in the update. Okay, whereas a year ago it was 8.5 debt. Now, the fact that they've gone from 8.5 debt to so I think it was this number here, plus minus the cash, which would be, where is it? Um, yeah, I mean, basically that number there is the comparative. The fact that they are sort of less indebted several years, or sorry, not several years, a year later, so one half 25 versus one half 26, and you can sort of see, oops, you can see here, look, the cash year on year net position, bearing in mind they sort of go into debt to buy all the Christmas stock that then gets sold at Christmas and Black Friday and Easter sales and New Year's sales. Like basically there's like a build up of stock in the first half, and then a splurging of spend, the selling of stock in the second half is the gist of it. But you can sort of see there's strengthening levels of net cash, which again I took to be a real positive. I thought that was a real positive. So again, it's not just looking at it from a net profit point of view that I can see an improvement to performance, and actually quite a strong improvement to performance. When you look at it from a cash point of view, I don't know that these numbers are definitively the numbers, because obviously we haven't had the accounts yet. We'll have those in a week's time. But again, if my numbers, if my estimates are anywhere close to the actual numbers, that's massively encouraging, because you can see it's working in a positive direction as well. Um, and then I suppose there's the final thing to say here was how much of this is just general sentiment and like all the doom and gloom. But at the end of the day, the British Retail Consortium said that things grew 0.9% to the year October 2025, that public sector pay is up 6.6, private sector pay is up 4.2. So there's lots and lots of positives in the economy. There's lots of reasons where you could say things are not as bad as the media would perhaps portray them. So this is kind of where I got to up to my article. I've updated it today just because now we haven't got December's results specifically from the BRC, but we have got November's results. So November basically was stronger. Stronger November, a week of December was kind of the result. So you can see retail sales grew 1.4% in November. Like for like sales grew 1.2. Now they do say that's the weakest level of growth and below expectations. So that was largely down to, or at least blamed upon, the budget and the uncertainty around the budget. Are they going to put XYZ tax on something or other? And they, of course, the budget was far less severe in some ways than some people assumed it might be. And then Christmas, it looks like maybe not a great result is the negative to leave this on. But those, that's the BDO high street sales tracker, is that the number of footfalls is down 0.5%. So not a great result. Could that be a real negative for the works? It could. Again, what we'll get next week is a sort of a trading update for the Christmas period. So whilst we'll only get financial figures up until October, we will also get a thermometer of how things are going. So look, I mean, none of these things, there's no investment advice here, and you make your own investment decision. But I think it feels to me like there could be a stronger outcome than is kind of being assumed. The fact that people have taken profits and exited out of the works, and it's now half the price of what it was before. Feels to me like it's potentially an opportunity. And I guess if you're buying these things for the long term, the other thing to say is that that whilst the first two budgets of the Labour government were quite tax raising. I think the last one raised 29 billion. The one the year before was it 42, 45 billion, something like that. I mean, so they've raised sort of 70 billion of extra taxes on people. But I don't know whether you noticed that quite a lot of what was being said, and I say an extra 29 billion, I think the actual wording should be it's an extra 29 billion by the year 2029, 2030. In other words, well, maybe it's not clever. The thing that they have done is they've basically forward planned what taxes are going to go in 2026, in 2027, in 2028, 2029. So, for example, if you're doing salary sacrifice, I mean, you've got another 3 years until that gets killed off. So, like if you I mean, I'm increasing my salary sacrifice because I've got another 3 years to take advantage of that, and then it's gone, which is dreadful, because at the end of the day, like, if you want to save up for your future, for your pension, well, why shouldn't you? Why shouldn't you be allowed to? But anyway, that's what's happening, unless another government comes in and replaces that law. And obviously, a lot of the time, these things don't get replaced. They don't. They just don't. So anyway, yeah. I mean, the point. Sorry, slightly gone off topic. I was going to start having a moan, but I won't have a moan. I'm just sort of telling you that my perspective is, and this is quite an important perspective. Um, there's been 2 years of uncertainty, inverted commas, and we're gonna. Oh, there's a black. And this was actually the other thing. There was a black hole. Do you remember that last year? Oh, there's a black hole in the taxes. We've got to fill the black hole. The truth of it was there was no black hole. Now, in fact, there was whatever the opposite, a white hole. I don't know. Basically, a surplus of 4.2 billion. There was no deficit that needed filling through extra taxes. The extra taxes have been, are going to be used for extra spending. That is the truth of it. But are we going to hear about black holes in 2026? I don't think so. I mean, they're now halfway through their term of office, third year. They are not popular. I mean, opinion polls put them at less than 20% popularity. So I think for this budget, we're going to have and the spring statement's coming before that. The spring statement's going to be in a few months. I think we're going to start to see like little giveaways, little tickles to kind of make people feel better. Probably some initiatives to try and drive the economy. Some positives, in other words. So I actually feel that the UK economy is. I mean, when you consider how much has held it back through Rachel's taxes and all the uncertainty around that, all of the cliff edge stuff that's been going on, that doesn't, businesses can't make investment decisions when there's uncertainty, or they won't, or they don't. So there's been a lot of things going on. I mean, energy prices have been through the roof. There's a promise now of lower energy prices potentially. So there's a lot of things that have fallen into place that should make 2026 a much better year, a better year for the works and a better year for a lot of companies. But that's kind of I suppose that concludes what I was going to cover. I think that covers the article as well, reasonably well. Yeah, even if it's just sort of modest, in like my estimates don't require them to kind of increase their sales by any dramatic amount. It really is just sort of saying like it only has to be slightly better than last year. I mean, 2.2 million, is that achievable? I'd like to think so. I mean, could that be higher? I mean, it could. And if it is that level, and if those costs remain, as I say, aggregate net neutral, that is, that appears to be what the result will be. But we'll see. Anyway, I just wanted to share that ahead of. I didn't actually record a video about this article from November, so I've revisited it today and been thinking about it today. So hope that's been useful, and thank you very much for watching. Cheerio for now. Cheerio.